Hello and welcome. I'm Bradley Maclean, co-founder of Regulation Asia, and I welcome everyone to today's discussion from ambition to delivery, carbon markets and the IOSCO recommendations. In the more than 1 year since the net zero promises of COP27, tangible progress has been delivered in a dramatically changed world. Yet energy supply, reliability and living affordability has become top priorities for most countries and policymakers across the world, presenting fundamental challenges to the global climate change agenda. Still, other issues such as double accounting of greenhouse gas emissions reductions, inadequate transparency, and greenwashing risks also need to be addressed for markets to reach their full potential. For me as an outsider, it appears that it will take a combination of vision and pragmatism from companies, governments, and society at large to reach our net zero goals. Carbon markets, as I'm sure everyone today will appreciate, remain vital to this transition. In November, IOSCO issued 2 consultation papers, the first outlining recommendations for jurisdictions seeking to establish compliance carbon markets, and the second exploring the attributes needed to foster sound voluntary carbon markets. So, what are these recommendations for developing carbon market infrastructure, maintaining stability, and ensuring carbon credit integrity and quality? Well, this is what brings us here today, where we're going to touch on some of the elements of these discussion papers, as well as delve into the efforts and initiatives underway to enhance trust in and scale up carbon markets. Now, joining us today in our expert panel, we have Kris Nathanail, Senior Policy Advisor with IOSCO, and she's also spent the past 4 years with the UK's FCA. Welcome, Kris.
Thanks, Bradley.
We also have Benoît, Gourisse, Head of Public Policy Asia Pacific with ISDA, who's also worked at several senior roles across numerous banking institutions. Welcome, Benoît.
Thank you very much, Bradley.
We have Kenber, Executive Director with the VCMI. He's also the ICVCM's governing body, as well as other many roles. Welcome, Mark.
Thanks, Brad. Morning, afternoon, everyone.
Morning and afternoon. And last but not least, we have Tom Enger, Head of Product with Climate Impact X, which is backed by the SGX, DBS, Standard Chartered, as well as Temasek. Welcome, Tom. Excellent. Now, before we delve into today's discussion, there is a little bit of housekeeping for everyone there back at home. Please, if you do have any questions throughout the session, we'll try to address them where possible, but please use the Q&A box along the way. Likewise, for those of you who haven't yet had a chance to download or read the IOSCO papers, we'll send you an email to the relevant links after the session. Okay, with that, I guess, it'd be great if we just jumped into it there. So as mentioned, IOSCO's 2 consultation papers propose a range of recommendations for establishing and scaling up compliance, as well as voluntary carbon markets. Kris, I guess as a starting point, given your role with those papers, is it possible if you could help us set the scene by helping walk us through some of the key objectives of the papers, as well as understanding kind of what was IOSCO looking to achieve, what has been the current response to date, and what is the time remaining before the comment period actually closes?
Yes, very happy to, Brad, and thanks to everyone joining today. So as you mentioned, Brad, we released 2 papers back in November 2022. And to take a step back, we released a consultation paper on compliance markets. Those are markets also called emission trading schemes, for example, where essentially a cap is set by regulation, and then on the basis of that, market participants trade emission allowances to be able to meet their emission cap. We have also released a discussion paper this time on voluntary carbon markets, and those are offset markets whereby companies can purchase offset credits created through projects that have been developed. And on the basis of that, they can offset the emissions that they produce that they are unable to reduce, so they offset them through the use of those carbon credits. There's a third type of carbon markets, which we haven't touched upon very specifically in those 2 papers. We've defined them as compliance offset markets, because those are the types of markets that will be falling under Article 6.4 of the Paris Agreement. And if you think about the Kyoto arrangement and the clean development mechanism at the time, that would also fall within that. Of course, those are very much falling under the remit of what the UN is currently negotiating with member jurisdictions. On the basis of that, we haven't touched that aspect. So why do we look at both compliance and voluntary markets? for two different reasons. The first one is we realize that carbon markets have a big role to play in the transition towards net zero. They're not the only solution, but they have a big role to play. Compliance markets in certain jurisdictions have been established for quite a while, but in other jurisdictions, they are only now turning to them as a potential solution to help them manage the emissions in their jurisdiction or region, as it were. So there, with compliance markets, the aim was to identify a set of recommendations that would help jurisdictions interested in setting up new compliance markets to do so, learning from the lessons of those who have come before them. So within the report, we have a lot of examples from the European Union, which has one of the most developed compliance market, for example, also the Californian emission trading scheme, or we have also examples from China, given the audience today is Asian. Now, on the voluntary market side, the aim was a little different. There are no strong, long-established voluntary market. It's a market that's been growing quite substantially over the past 2, 5, 7 years. And so we realized that they also had a role to play. But they can only do that if they function with integrity, with transparency. So we wanted to dig into them a little bit and start having a conversation with market participants about what some of the important considerations should be for those markets for them to work properly. So within that discussion paper, we've set out a set of what we have called key considerations about how, as financial regulators, we feel those markets should be regulated, learning from how other markets were developed in the past, for example, the swaps market. So really trying to take examples, once again, from what we've done before, looking at our derivatives principles as one of those sources for the work we have done, and really saying to the market, are we going in the right direction with this? Are there considerations that we haven't thought about? Both reports are out for discussion and consultation. The consultation on both closes on the 10th of February. So hopefully we will be getting a lot of answers by then. As you might know, Brad, we don't tend to get responses to consultations within the policy world until a week or so before the end of the consultation. So I can't tell you at the moment we've received 50 responses, but I'm hoping that we get a good number when the consultation closes.
Not a problem. I mean, obviously you're very optimistic about that. I mean, Benoît, as I understand, ISDA is also focused on a range of initiatives to facilitate the development of voluntary carbon markets. Can you walk us through some of these key initiatives and the progress you've seen so far?
Yes, thank you, Bradley. Well, I think the commonality that we have with IOSCO is our international focus. As you know, we have more than 1,000 members across 78 different jurisdictions. So we always look at this from an international perspective. And we are always very nervous when we see too many non-coordinated national initiatives and inconsistency. We want consistency. We don't like fragmentation. We want standardization. And to be clear, if IOSCO is able to go ahead with standardization through principles, as we saw in the past when they participated in the WGMR group with the Basel Committee, that ended up with the non-cleared margin rules, or such as benchmark principles that were published already almost 10 years ago. Time flies. So we would strongly support that. So our role as a trade association is very much on the legal side of things, because all the questions that were triggered by the development of voluntary carbon markets have been about the type of legal documentation that we can use if we are using this master agreement. Where should we put the carbon markets? Would that be under the commodity bucket, which probably from a legal documentation perspective makes sense, but that triggers some other questions. And interestingly, these questions were also raised in last year's consultation from IOSCO on the review of their commodity derivatives principles. What kind of rights do they have? One of the biggest questions I think that people have in mind is whether On carbon credits, they have an ownership right or just a creditor right. That's very important in case there is something wrong. This question is exactly the same as in the crypto space. I'm sure that currently investors who are buying crypto through FTX would very much like to know whether they have an ownership right or whether they are just creditors. So these are very big questions. We are trying to give some tools. So we reviewed our legal documentation. We published the legal documentation for sustainability-linked derivatives in carbon markets. Recently, we also reviewed and we published last month definitions on the legal nature of voluntary carbon markets, notably for Japan and Singapore. And we will continue this work, but as ISDA is very much focused on derivatives, we will not go beyond our remit. I know that some very large banks operating globally are very much concerned by other ESG issues, such as the taxonomy and how the taxonomy should reflect in their disclosure requirements as listed issuers, as product manufacturers, or banking services providers. This is none of ISDA's business, and we will limit our focus on carbon market. But it's very important, and as I said, consistency, standardization rather than fragmentation. And we are slightly concerned by the development of many national initiatives, particularly in Asia Pacific.
Interesting. So you've mentioned there's standardization, the legal documentation and things like that. But one of the items which I kind of think we missed a little bit was the quality of carbon credits, which I assume is also very important.
There is always a debate between liquidity and a very robust framework. In this area, we do not want greenwashing. So we would support very robust governance and issuance on carbon credit. It's very, very important to have good quality credit. And the work done by the ICVCM is very important. We looked at the consultation. We noted the requirements suggested by ICVCM, particularly, for instance, on the fact that the funded initiative should be transparent and should assure that the result in carbon reduction should be permanent. These are very positive signs, and we will follow up that closely. The quality of credit is very, very important because as a citizen, but as part of my organization and all my members, I think would agree with that. One villain in this market would endanger the entirety of the market because of the very strong focus from all policymakers.
I mean, the timing of our panel is quite interesting. I mean, there was just, a couple of weeks ago, the Guardian's report around Vera's approved forest credits and some claims that they do not represent genuine carbon reductions. And while this is obviously very topical right now, the quality of credits and concerns around that is nothing new. I mean, Mark, you've been focused on carbon markets, I think now, for 20 years. You also were the founder of the Gold Standard as well as Vera. As I understand it, the VCMI, you've also developed a code of practice that's being road tested as we speak around trust and confidence in carbon credits, as this obviously continues to be an issue. I mean, Mark, can you walk us through, I guess, how these issues are being addressed?
Yes, of course. Thank you. Let me just start with the kind of articles that were published about Vera. I should declare now that I am, as well as the founder, I'm still a board member of Vera. So I've obviously been kind of closely involved in the discussions here. Look, there's no doubt that the allegations based on the evidence that was provided were damaging. I think you've seen both from Vera itself, but also a number of other actors in the market, none of whom, I should just emphasize, no one's saying that the market or the RED Plus projects are perfect, but there's been a lot of pushback on how the assessment was done, what underpins the analysis. But probably more important, and this is an important function of the voluntary carbon market itself, is that it was designed, and if you look back to the speech, if you can be bothered to look at it on YouTube when I launched the VCS, it was very clear that part of the role of the VCM is to drive innovation, drive experimentation, and provide a forum for continuous improvement. And we've seen this, and one of the responses that people will see to the issue of RED Plus projects being developed by Vera itself, but also under the aegis of the ICVCM, are the introduction of new methodologies. None of these standards stand still. Verra now is on Verified Carbon Standard version 4.0, and that's based on improvements, reflections on experience, and recommendations from stakeholders over the whole of the lifetime of it. So, for example, we've seen changes. Most of the major standards led by Verra no longer allow grid-connected renewable energy in middle-income countries, because pretty much it's impossible to say whether they're additional or not. And it's pretty clear that many of those projects can stand on their own 2 feet. So we would expect this sort of evolution and innovation to take place. And that, is one of the parts, or one of the basic ingredients of the trust that is needed to underpin a market. Now, let's not forget, the voluntary carbon market exists for a public purpose only. What is it? This is to drive greater greenhouse gas mitigation than would happen otherwise. People often talk about additionality at the project level, i.e. a project should be driving an emission reduction that wouldn't have happened otherwise. But this needs to happen at the level of the market as well. If all we're doing is having credits and money changing hands, but with no impact on the climate, that's of no benefit. And so that mitigation benefit, but also driving climate finance or carbon finance to where it's most needed for the most urgent emission reductions, such as protecting tropical forests, the REDD+ projects, but also others, that the market needs to be judged against that. And because it's a voluntary market, because many of the people in the market know that it only exists because we have failed so abjectly to have economy-wide policies, to have corporates clearly on decarbonisation paths on the road to net zero, people, I would say, tolerate this market, see that it has a benefit, but are going to be particularly careful at scrutinising whether it is delivering against that public purpose. I don't believe, and I'm not suggesting that Benoît was saying this, but I don't believe that there's a trade-off between robustness, integrity on the one hand and liquidity on the other. Quite the opposite. While this is a market that has grown bottom up, integrity has been seen and continues to be the basis for trust, and for trust is the basis for growing the market. We can't have one without the other. Both Kris and Benoît mentioned transparency as a key part of this, and I think, going back to the questions about the Verra REDD projects, the fact that it's possible to scrutinise that all the information of the projects is in the public domain, that you can do that analysis, is a strength of the market rather than a weakness. We would rather have that scrutiny by NGOs, by the press and others, because that's what drives improvement. That's what drives people to question projects, enables people to rank and rate projects and credits based on their quality. And transparency is fundamental for that. So if there's one thing I would say this market needs to be able to build trust and grow, it is transparency.
I like that issue on integrity, about the balancing act between integrity and liquidity, and we'll come back to that hopefully in a moment. But Tom, how is Climate Impact X addressing these types of issues such as trust? And I guess more broadly, how are you looking to put the IOSCO principles into practice?
Yeah, thanks, Brad. I think the establishment of Climate Impacts in Singapore is kind of an expression of that hope that we can build trust and transparency in execution of safe platforms. For your audience's awareness, CX was established in Singapore with the help of Singapore Exchange, 2 banks, Standard Chartered and DBS, who are active in sustainable finance, as well as Temasek, which is Singapore's government investment company. And this means that these shareholders have pretty high expectations that the marketplace and exchange platforms we create are robust and safe and orderly marketplaces for pricing and trading. Now those kind of expectations that banks have of bank grade services, or an exchange has of exchange grade services, speak exactly to the concerns here, that we would like to be able to help scale markets through trust in the credits and in safety of the pricing and trading, and in the integrity of and that there's responsible use of those credits afterwards. So I'd say that we've been going about trying to implement that trust through some of the platform facilities. We have a project marketplace which caters to corporates who may choose to buy to retire credits. And in that environment, we build trust by explaining that these credit types are from reputable registries. And we help with content and with technology providers to explain how they are trustable. We have an auction house which helps to elevate new credit types. And that's because the market is very young. So it's important to explain what a mangrove project is or a new tech credit. And that helps to elevate trust in the credits. Again, as Mark said, we need to be transparent about those risks and those impact qualities of the credit types so that broad scale buying can occur. And we also have a trading platform which is launching in a couple of months. And that's, of course, for a professional audience. And those financial institutions and traders who support that scheme will look for the usual safe, orderly market behavior. So we leverage, of course, SGX's experience on the technology side and SGX RegCo as a self-regulatory organization to build trust in the process of buying and delivering credits.
So yet again, another point I'd like to come back to in a little bit will be the role of speculators in the voluntary markets. But before then, Kris, I mean, yet again, obviously the consultation has been put together. We're getting the feedback now, but how does IOSCO see its role in addressing a lot of these vulnerabilities and ensuring carbon and credit quality? Kris, you're on mute.
You would think after almost 3 years doing this, thanks, Brad. What I had started saying was that the way we had approached looking at the work on voluntary carbon markets obviously relates to our objectives as securities regulators, and that's mostly market integrity and investor protection in the first instance. Now, as we were doing the work, we looked at it through 3 lenses. The first one concerns at project level, what are the vulnerabilities that we could identify there, and obviously the integrity of the carbon credits through the quality of those credits was one of the first pieces we identified as a potential vulnerability. The second one was perhaps the most familiar to us as securities regulators, and it was looking at the characteristics of the trading environment, the market infrastructure, and the behavior of the participants in those markets. And then finally, we looked at it through what we called communication around the use of carbon credits. So essentially, how is a company reporting on its accounts at the end of the year, how it has been using carbon offset credits as part of its sustainability reporting component. On the back of that, we developed 14 considerations, and once again, they follow the same sort of thinking, looking at market integrity, market efficiency, and investor protection. Now, some of the aspects that Benoît mentioned, for example, around lack of standardization, lack of legal clarity, were items that we also identified, and they appear within both the vulnerability section of our discussion paper and then within the key considerations as something that we feel the market could look to improve. How? Well, for example, on standardization, we call for work to be done there because we believe it would improve liquidity. We also call for better levels of transparency because we feel that it could improve market efficiency. How do we do that? Well, for example, having more transparency about the information on transactions. So pre-trade transparency, but then offer prices, for example, as well as post-trade transparency once the transaction has been completed, the use of typical clearing and settlement infrastructure that you see in other markets, potential move towards more centralized trading platforms. So, the work that our colleague at Climate Impact are doing is great from that perspective. And we've also looked at issues around conflict of interest, potential fraud and manipulation. We're offering some considerations around that. Now, with regards to credit quality, we recognize that a lot of work is already being done by other participants at the moment in the market. So then we took a bit of a slightly different approach where we said in the discussion paper, we asked for views. We said, look, we know others are doing work on this. ICVCM, for example, being one of them. Should we be collaborating with them? What would you like that to look like? And what can we learn from the work that they are doing on creating principles for high quality and global standards for carbon credits? That's a sort of approach we've taken, both in terms of identifying vulnerabilities and then proposing considerations on how we feel the market could solve those vulnerabilities. And as I said earlier, it really is building on work that we've done in the past in other types of market as well. So we're not making some of those proposals up, right? We've learned from what's happening in other markets, and we're trying to bring some of that expertise into voluntary carbon markets.
So liquidity has been mentioned several times. I mean, Benoît, I wanted to go back maybe to Mark's comment about the idea of balancing liquidity and integrity. I mean, why is liquidity such a challenge? Where are the bottlenecks? And how do you see the issue of liquidity being addressed by the markets?
Thank you, Brad. So first of all, I fully agree with what Tom said. Liquidity and with Mark, what Mark said. Liquidity and integrity are not to be opposed, especially in these markets. I think the robustness of the governance and the quality of the credit would create liquidity. The threats that we see on liquidity, again with an international perspective, is about the fragmentation of markets. We fully recognize that compliance markets have always been very national for many historical reasons, including that energy markets have always been very national, electricity market, gas markets, and we fully appreciate that. Voluntary carbon markets, we would tend to see benefits in international convergence and with one big global market. But this is not what we see in practice. We saw the development of initiatives at national level in Hong Kong and the Greater Bay Area, in Singapore, in Malaysia. We expect further developments in Indonesia, in Korea. We saw also Japan. What would India do? China, maybe Australia. If we end up with 10 or 12 voluntary carbon markets at national level in Asia Pacific, I'm not sure how market participants will be able to find a sufficient liquidity in each one of them. So that's the first concern. A second one is more on the regulatory side. There are two problems here that I want to highlight. The first one is the capital treatment under Basel rules, and the second one is the tax treatment. Under the Basel rules, well, it's pretty simple. When you look at the fundamental review of the trading book that the jurisdictions will start applying in the next couple of years, you see that the standardized approach to capital calculation assigns a 60% risk weight to carbon trading. This is one of the highest of all commodities. Mm-hmm. So that will certainly not help liquidity in these markets. The very high risk weight approach to carbon trading is an issue. And we published 18 months ago a detailed analysis based on historical data from the EU emissions trading scheme on that subject, because as you know, the EU ETS represents nearly 80% of global trading in carbon credits. And we found out that the risk weight for carbon trading under this market should be 37%. So Basel is 60%. It's 1.7 times higher. So that's a problem. The second problem is taxation. And here, also capital treatment, Basel rules, these are international standards. Tax treatment, we are going back to national levels. Because in some countries you have, what we call the carbon taxes. Even if I'm sure if you ask European citizens at the moment about these initiatives, you'd better run fast once you suggest this idea. But this can exist in a number of jurisdictions. That would be a disincentive, because a carbon taxation basically means an extra layer of taxation on transactions, and that would be a problem. The second one is the carbon border adjustments. which look more like protectionism to me, and that also exists. And maybe a third one is some specific duties applicable to certain transactions in certain jurisdictions. I think we were slightly surprised when, for instance, a very large jurisdictions like India, when they developed their non-clear margin framework for both variation margin and initial margin, we were surprised to see that the posting of margin will be subject to certain level of taxations in India at federal level or at province level. This is not helping. And if that happens also in carbon markets, that's another problem. So we see potential barriers to the development of liquidity. Fragmentation of markets, if we have too many national initiatives, capital treatment under the Basel rules, and we are constantly liaising with the Basel Committee to get recognition that they probably went one bridge too far on carbon market, and then taxation. But on what is purely national, our ability to change things is limited, and we hope that further international cooperation happens here to avoid bottlenecks. Yeah.
Kris, I mean, yet again, any other challenges or potential remedies for some of these liquidity issues?
I think Benoît mentioned fragmentation. It's always a risk in markets. It's particularly a risk in nascent markets because everybody wants to develop their own. I think, however, it's part of the life cycle of a financial market, whether it's carbon or anything else. When something is quite new, they do tend to happen at national level, and then over time you get to see some consolidation. I think from our perspective, the most important aspect at the moment is making sure that there is a sort of baseline based on the key consideration of what those markets should look like, because if they operate broadly along the same lines, then over time you can transfer to something more international in a much quicker fashion. If you look at compliance markets, while it's true that they're mostly national or regional, you are starting to see some linking up of the schemes. So there is potential for that to happen, not only in compliance markets at a greater level, but also over time in voluntary carbon markets as well. It's something we should remain aware of, however.
Tom, you're uniquely positioned in Singapore. I mean, Benoît mentioned, the unlikeliness of a single global international market. But do you see potential, for example, in your part of the world, for regional markets?
Well, yeah, I think it is the right question to compare what people are trying to achieve on domestic markets and international markets on the other side. So domestically, I think if you can assume, like, say, gold markets, there will always be national attempts to build gold exchanges because there is local demand for carbon supply and carbon demand inside countries. People like to buy local and support local projects. But simultaneously, there is also an international market for credits that are international supply, international demand. And this we also find in other commodity markets. So I don't think it should work any differently. It's just that those domestic and international markets work at different levels of scale and affordability. Internationally, what CIX experiences is that liquidity is indeed very fragmented, and that means fragmented across a 24-hour cycle globally. And one way we help to try to solve for that is to compress all that liquidity into a half-an-hour pricing session and concentrate liquidity and price discovery with market-making programs and price discovery sessions. This is learning, as Kris said, from commodity markets where we've proven some of these techniques to concentrate the available liquidity in the market, which isn't able to support 24-hour trading. The other thing about liquidity is you do need standardization. So as Kris said, if you can develop fungible contracts which people can build liquidity around, then clearly what comes with that is more delivery certainty and more retradability, and even risk management products like derivatives can be spawned off the back of that. And finally, we fundamentally agree that liquidity is a function of transparency, because if you don't have pre-trade certainty about what you are trading and the price of those vintages or qualities, then you can't participate. So it is important that there are centralized marketplaces with screen-based orders, benchmark methodologies, contract change governance procedures, other governance policies. I mean, these are what are considered normal expectations in commodity markets, expectations of spot and futures exchanges. And I think those are necessary in carbon to build up confidence and build up liquidity. Ultimately, if you have price transparency and you have confidence in trading, then you get a virtuous wheel of pricing and trading. And that's really something that drives liquidity in the system.
I understand that the need to have liquidity is, I guess, a sign of the market development, but I wanted to understand maybe a little bit more about the roles of different market participants in carbon markets. As I understand, we have corporates, we have financial institutions, market makers, and I guess I'm curious to understand the role of the speculators. Now, I'm not sure, Benoît, Mark, you might have different viewpoints on this, but as I understand, akin to the compliance markets, there remains a reluctance to allow speculators to participate in the voluntary markets. I mean, Mark, do you have any thoughts on the role of speculators in voluntary markets?
Yeah, I do. So let me come back to that, but I think put it in the context of the previous conversation. A lot of the discussion we've been having so far, quite rightly, is about how do we create liquid, robust markets. But it's really important, and I go back to this point of the public purpose. Having a liquid market is only valuable for that public purpose if it drives more investment, if it gives confidence for people to invest in more projects that reduce or remove more emissions. A liquid market with lots of things, just lots of credit circulating, but not encouraging or giving the confidence for investment may be beneficial to some people, but it's not serving that public purpose. And I think that when we ask about transparency for who? Yes, we want price discovery, we want those conditions that help the market function, but it's also transparency so that I, as a member of the public, so that the press, so that the communities involved in projects, so that the companies who are buying the credits because they want to make some kind of claim know what it is that they're getting. That's not only transparency about price, but it's transparency about, was anyone kicked off the land from the project that's protecting a forest? Has the community shared in the benefits? And because these markets are supposed to drive sustainable development and climate action. So it's important to think of regulation to cover all those things. And not all of that may be the role of financial regulators or market regulators, but they are essential to building trust. Now, so one thinks about transparency for who, standardization for who, it's got to serve the market as a whole. Now, why are people reluctant to allow speculators? I mean, I think it's important to, from my perspective, one person's speculator is another person's investor or market participant. It depends a bit on the intentionality. I think what people are concerned about is this is a sophisticated market, and this is why almost all the voluntary carbon market registries don't allow individuals to have accounts. You have to be a company that has passed KYC, has KYC rule checks in place, because this is a sophisticated, not very easy to understand market. I wouldn't want my mum or people to be sold, some derivative of a carbon credit by their financial advisor. It's just not appropriate for that. So I think it's partly safeguarding people in the market, but in as much as there are traders who are in the market for profit, that is absolutely fine. I mean, that's part of any market, but as long as we don't lose sight of what the purpose of this market is. When we come to standardization, that's fantastic in as much as it allows fungibility, allows people to trade credits. But let's not forget that underlying voluntary carbon market transactions are people and projects. And all of these projects are different. They are different, hundreds of different methodologies, hundreds of different project types, different contributions to sustainable development, and so on and so forth. And this is why the ICVCM has developed its core carbon principles, will have a number of tags that differentiate between credits. So we've got the balance between a market that stands trading in a standardized fungible product, but also that underlying that project, there are a whole range of different characteristics which also, satisfy different demands in the market. Some buyers want to buy projects from removals, others from reduction, credits from removals projects, others from reductions, some from nature, some from technology, and so on and so forth. But it's also, just one final point on this, it's kind of important to think that this purpose of driving a more climate change or greenhouse gas mitigation has to be seen as part of the bigger picture. If all companies are doing is substituting carbon credits for effort that they would have taken internally, and there's no net benefit to the atmosphere, then that doesn't get us any closer to our net zero goal. And that's why VCMI, the organization I lead, is looking at the demand side of the market. Many of the initiatives are looking at the supply side, projects and credits, but we've developed a provisional code of practice, consulted on it last year and had 70 companies road testing it to look at two questions. When and under what circumstances should companies be using carbon credits, and what can they claim about it? And so part of this standardization is about claims, about when somebody says they're carbon neutral or somebody says they're climate friendly, that those things mean the same thing, that they are part of disclosure requirements, that they are regulated. We hope we're doing this on a voluntary basis, but that's where we hope regulators will step in for claims about consumer protection, advertising and disclosure. And that's as important a part of the market as the regulations around the functioning of the market itself.
Benoît, I mean, is there a reluctance to allow speculators? Is this simply about investor protection or the way that we can, or how we define speculators in the market?
Well, that's a key question. I'm sure if you have a very, very bad behavior in the market and you show some figures and some details about this behavior, a child will tell you how bad this is as a speculation. If you ask lawyers to sit at a table and to define under a law what speculation is, you will never get anything in the end because it's way too complicated. So I'm always a bit nervous when I hear about preventing the presence of speculators, that it might mean, after all, this is all about carbon reduction, emissions reduction, so why should we allow the financial firms in these markets? Which is exactly what we faced 12 years ago in Europe, in the aftermath of the global financial crisis, about the regulation of commodity derivatives markets, where there was a huge campaign in the European Union to ban the presence of banks in the commodity derivatives markets, on metals, on agricultural commodities, for instance. And then the problem is that, okay, but if you exclude the market makers, you can call them speculators, but if you exclude the market makers, the liquidity providers, the regulated entities, basically, who are you left with in these markets? Non-regulated entities who may step in to hedge certain risks without having the financial capabilities. This is something that we saw 10, 12 years ago on certain commodity markets, and I would not want that to happen in carbon markets. So the key thing here is not about preventing speculation. It's about using the tools that regulators have to really sanction the misbehaviors. There are tools. There are market abuse frameworks everywhere to prevent and to sanction market manipulation, false information, insider trading. I think the key point here is about enforcement. If regulators are able very soon to identify the misbehaviors and to hit hard the people we could call speculators or market abusers, then will remain safe. But if we preempt and prohibit the presence of what we call speculators in a very broad sense at the beginning, I can't see how we can develop these markets. And one thing we need to keep in mind, and on this, governments and the private sectors agree with this figure. The estimation is that we need 125 trillion of US dollars of investments to meet the 2050 net zero target. Governments cannot do that alone. they will need the support of the industry and particularly of the financial sector. So it's very much about using the existing tool, make sure that these market abuse tools are applicable to carbon markets and commodity market, because that was also a tricky question 10 years ago, and we realized that in certain countries that was not necessarily the case. But once we are sure that regulators can step in and enforce, then we need enforcement.
So Tom, 125 trillion. So obviously there's a lot of potential for market abuse there. Given the tools that Benoît has just kind of said we need to be looking at, what are the types of controls or guardrails that you're putting in place within your own kind of platform at the moment to prevent these types of market abuse?
Yeah, I think everyone's correct that it's important here to focus on what kind of user you're protecting and how you're protecting them, because carbon markets are unusually broad in the diversity of potential participants. So to give you an example, you have corporates who are buying credits in hypermarkets to offset or to retire them. Now, their concerns, the concerns you might have there are anti-money laundering or simple fraud, double counting, double representation of the credits. Now, those can be mitigated by good KYC. They can be mitigated by using banks as intermediaries who represent those clients. It can be mitigated also from the credit point of view, as Mark pointed out, by having high integrity on registry credit types and not any old credit. So those are the kinds of things that we naturally implement. When we think of auctioned credits, of new types of credits in the world, and that's a good thing. There's a Cambrian explosion of new registries and new technologies and new types of sequestration. What's important there is to avoid misrepresentation, make sure that those are legitimate, even though it's an evolving science. And one way you can do that is by working with technology providers, who are satellite providers or remote monitoring, AI, ML, and others who use algorithms to confirm, or work with academics to prove that this is the most robust science. Now, when it comes to secondary markets, there is, of course, a professional audience of traders, financial institutions that fully know their risk and don't need to be handheld. And they expect certain mitigations in highly liquid secondary environments. And those things would be put in as a matter of course by a centralized marketplace. So you wouldn't want to over-regulate that space, but you don't want to provide access to everybody because it's just asking for too much risk. So I think it is, horses for courses, and the market will sensibly sort those things out. It's just that this market is extremely diverse in its application.
Kris, does IOSCO have a view on mitigating potential risks of market abuse within carbon markets? You're on mute again.
Quite clumsy with the mute button today. And surprisingly, we do, as you might expect. And I think Benoît is right. Without deterrence of abusive conduct, you can't promote confidence in market prices. You can't promote integrity in the market. And without those two aspects, you don't have a market that will function over time or that will be able to grow. So we're absolutely very interested in that question, and we have indeed proposed a key consideration within the paper on voluntary carbon markets that is aimed to be looking at that. So it's, on the firm side or the exchange side, it's about having good compliance function in place, KYC and anti-money laundering rules that are respected. But it's also about providing transparency to the market and to the participants in those markets around if there are any fees for ancillary services, for example, discounts or what you pay to third-party providers, what are the criteria for issuing offsets, or what are the criteria for market participants that are seeking to connect to the trading platform, for example. And that touches a little bit upon the point Tom was making around who participates in those markets. And then on the regulatory side, we've proposed considerations around putting in place rules that allow you to get sufficient data to be able to identify when fraud is taking place, when markets are being distorted, perhaps because of insider dealing, for example. But most importantly, once again, going back to the point Benoît made, those rules mean nothing unless you have enforcement programs that will monitor and will act when necessary. So we've also proposed some considerations around having those enforcement programs in place for the regulatory community.
So we've discussed quality, standardization, liquidity, price discovery, I guess, is one of the big other aspects we haven't really delved into so far. I mean, Benoît, based on the analysis of current carbon pricing landscape, recent research by the UN Environmental Programme recommends that the current carbon price should triple by 2030. Do you see the right price debate for carbon as a necessary distraction, or what, from your perspective, would be the right approach to price discovery for carbon? You're mute, Benoît.
Sorry for that. First of all, I don't know what the right price is. You know, until the Yom Kippur War in 1973, the right price and very stable price of oil was $3 per barrel for 25 years. So that was the right price. 6 years after the second oil shock, after the Iran Islamic Revolution, it was, I think, 20 times that. So I don't know what the right price is. Probably market participants would tell you that today the price is indeed too low. Now, would that be double, triple? I don't know. But it is probably too low. Now the market will evolve, will adjust. I just have no idea what the right price should be or is. And no one is able to say that. We are not able to say that for a single stock on the stock exchange. We are not able to say that for a bond. And so certainly not for carbon. But it is very clear to me that at some point, not all the national markets that were recently created will continue to operate. To use a parallel, the situation today makes me think of the car manufacturers in the 1920s. You had dozens and dozens of car manufacturers creating this new tool. And 10 years after, the market adjusted and only a handful of them were left. So I think that at some point, some of these voluntary carbon markets that were created in the past couple of years will stop because of the lack of liquidity. And then when you'll have less markets, but deeper market with more liquidity, you'll have price adjustments and you'll come to a price that is closer to the economic fundamentals. But I don't know what the right price is.
Tom, do you have any thoughts on price discovery for carbon?
Oh, too many. I will give one perspective, from the supply side. If you think of the cost of production, well, clearly not all carbon projects are created equally. So if you take a cost curve, at the bottom you have renewables, $2-3, cook stove, 7 or 8, RED plus projects between 10 and 15. You have removal projects, mangroves at 25, and then up here in your tech sector, you're going to have biochar at 150, mineralization 250, direct air capture 300 plus. Now, in this cost curve between $2 and $300, it's a function of how much you're prepared to pay to bring that solution to the market. But then there's another lens, like Mark elucidated, that actually a lot of projects have a lot of co-benefits or other things more than carbon baked into the project value. So a nature-based solution has biodiversity and the community impact for indigenous populations and local communities that is essentially priceless. Or many people would price rainforest preservation around $150 of social value. So these expressions of what price should be or need to be are not really very well implemented in market terms. Essentially, this is the world's greatest market failure in terms of price that is going on. Another lens is from inside a company. A company can set its own carbon price in order to establish projects that it implements at a reasonable price to offset their emissions. And countries obviously can do the same. So one way is to regulate a minimum price. Another way is to make a market-based action that incentivizes a good you want to see. And neither is right or wrong. They are both appropriate. But fundamentally, carbon prices have to rise in all respects, in all places, in order to justify enough scale and enough investment into the sector.
Excellent. We have a couple
pick up on the last point that Tom meant. I mean, go back to what is driving investment. We need at least rising prices so that projects that are not viable at the moment, those projects that are really additional. And I think one of the problems we have with additionality at the moment is if you have market prices of $2 or $3, which include transaction costs, a margin for the project developer, some sharing with the community, it's quite hard to find projects that are going to meet that at the IRR threshold and really be additional. I wouldn't have happened without the carbon finance. I mean, if you're thinking, tons of carbon that wouldn't have been reduced without maybe $1 net being paid to them, that's very hard. And I agree with you, Benoît, there is no kind of right price for the market, but there are things we can compare it with. We can compare it with, for example, the social cost of carbon that's estimated by scientists at about $185 a ton. The US government has a social cost of carbon of $51 a ton. So that's comparing sort of what's the impact. That's not obviously a metric for pricing, but it does suggest that if we get closer to that, then we're likely to drive much more ambition in terms of emissions reductions, many more projects, many more technologies. I mean, Tom, you mentioned some of the tech end of the removal spectrum. It's kind of hard, and I know Climate Impact X is doing a lot of work on this, to get a really big liquid market in those sort of credits at those with prices so low and costs so high. So we need some sort of convergence that will enable the cost to come down because there's more liquidity in credits in those sectors and more investment, and also drive more investment overall. So I don't think that's the right price, but it is thinking about, and at the risk of sounding slightly Marxist, not confusing value with price.
Okay, convergence and not confusing value with price. I mean, we've got a couple of minutes left. I mean, Mark, as we look ahead to the next 12, 24 or 36 months, given your experience doing this for the past 2 decades, what are your expectations for real progress on the challenges and opportunities discussed today?
Well, I think first we should accept that it's going to be bumpy. It's always been bumpy, and there are lots of new initiatives, and sometimes regulators will work at cross purposes. Standards bodies like the ones I work in will work at cross purposes, and these need to be ironed out. I think the emergence of market infrastructure, represented by many of those on the call today, is incredibly important, and that will give the sort of confidence that the market needs, but also that the public in general need. I think there is still a lot of work to be done working out how the voluntary carbon market will interact with the new markets emerging under Article 6 of the Paris Agreement. For example, the Article 6.4 supervisory body has still got a lot of work to do there. In one of the decisions in COP27 in Egypt last year was the creation of these new mitigation contribution units, which can be used by the voluntary market, and therefore there's a sort of begins to be a bridge between the two. I think many of us who've worked in this for a long time will hope that over the course of the next decade, all those markets will converge, particularly as where credits are used by corporates. But it's going to be bumpy, and so we shouldn't be surprised if we have exposés and analysis like we had going back to the beginning of the conversation about RED Plus projects, that we see competition between different standards, what is acceptable and what isn't. We'll see market participants enter and then leave again, and we've seen this in the validation and verification space where companies are saying we can no longer make money out of this. We'll see people get burned, but it's important that we don't lose, we see that as teething troubles, that we don't brush them under the carpet. We use them as ways to learn lessons that improve the market over time. I think it's going to take time to mature, but I think it will, and I think it can play an incredibly valuable role if we do it right.
Benoît, anything to add from your side in terms of expectations for real progress within the short to medium term?
Well, we hope and expect more standardization in the voluntary carbon market. We hope that there will be adjustments. Now, I think the very big question mark is how the entire ESG framework will go ahead in the European Union. The energy crisis is triggering so many political shifts and so many questions that it's very difficult to say what will happen there in the next 18 to 24 months. And Europe is very important here because they have always had this very strong focus on regulating these markets, which is very different from the United States of America, for instance. So if you have one very large jurisdiction with lots of question marks as to where they are going, and another very large jurisdictions where it's very simple, they do not want to step in and to regulate, well, that's a challenge. So it's difficult. We hope voluntary carbon markets can be not national, but more international. And we'll definitely hope we'll see the end of the current energy crisis, because that would help, of course.
Tom, I hope you're a little bit more optimistic. I think you mentioned that you'll be open for trading as an exchange in the very near future. What are your thoughts in terms of real progress in the short to mid-term?
Yeah, look, I think everyone should have grounds for optimism, and there are enormous numbers of companies who engage us in trying to understand how to start on the journey to footprint their emissions and to understand how to reduce their emissions and how to compensate or offset the remainder. There are standards that are rising all the time because the financial community is now engaging on the issue. Regulators are engaging and governments are engaging. Those kinds of market infrastructure and trust-based solutions are coming quickly to the market. I think that there's definitely always grounds for improving the quality or integrity of credit types, which are very difficult to assess because they are often in difficult or hard to protect parts of the world, or they are new and difficult technologies. So as Mark said, I think the market should bear with everyone to kind of improve gradually the system.
Kris, any final thoughts, or I guess more importantly, how can people get involved with the consultation?
I think in terms of final thoughts, I won't repeat what both Benoît and Tom have said. I agree with what's been said. Perhaps finishing with a call for action, which is please respond to our consultation or 2 sets of consultations, which close on the 10th of February.
Wonderful. And that, unfortunately, we're out of time. As you can tell, we've only just started to scratch the surface today. We've left out an entire discussion around the role of the US, as well as uncertainties around Article 6. But we also couldn't answer all of the questions from the audience. Still, we do welcome our listeners to email us for any additional questions and visit regulationasia.com to keep track of this space and learn a lot about ISDA's initiatives, IOSCO's, as well as everyone else who's really focusing on this space. I would like to remind you that IOSCO's consultation papers are open for comment until the 10th of February. About 2 weeks, I think, from now to get your comments in and contribute to the final recommendations. Finally, I'd like to thank our panelists for their insightful discussion. Kris Nathanail, Senior Policy Advisor with IOSCO, Benoît Gourisse, Head of Public Policy Asia Pacific with ISDA, Mark Kenber, Executive Director with the VCMI, and Tom Enger, Head of Product with Climate Impact X in Singapore. Thank you for everyone who dialed in today and to join the discussion. We look forward to speaking with you all again very soon. Thank you and goodbye.